This is Traders Workshop with Adam H. Grimes. Hello, welcome to episode 20 of Traders Workshop, Questions and Answers. I'm your host, Adam Grimes. You can find more of my work on my blog, adamhgrimes.com, and I'm going to highly suggest you follow me on Twitter at AdamHGrimes. So this is going to be kind of a grab bag of questions, some that people have sent me, some that have a really good one came up in some of my coaching work today, and I wanted to share a few thoughts with you. And also, if we have time at the end of this podcast, I'm going to share an idea from my work with classical piano that I think might help with trading, but we'll see. I doubt we'll have time for that. Maybe the next episode. Okay, so I was working with one of my coaching clients today, and I'll tell you a little bit about this guy. He recently graduated from college. We started working together about a year ago, and he had zero trading experience. And this is one of the things that I like to do as a coach. I like to work with people all across the spectrum. I work with professional traders, fund managers, people managing a lot of money, old floor traders, everybody from portfolio managers to day traders. And I also like to work with complete beginners because actually I find a lot of, I don't even know what the word is. First of all, it's obviously very satisfying to lead somebody along those first steps, but it's also kind of nice to have the blank slate because we can avoid some mistakes. And anyway, this guy has, I'll just tell you, let me tell you his numbers. So he's trading live. Last few months, he's a swing trader. He has done some options, but this is swing trading. August, he booked 1.5% on his account. September, he booked 4%. And October, he booked a positive 3.4%. And he scheduled this session with me because he's in a very bad place psychologically. Now, I want you to take a moment and reconcile that with what I just told you. So the last few months, let me read you these numbers again. 1.5%, 4%, and 3.4%, all positive, all real money, end of month. Now, there's a little bit more to the October story, and we'll get into that in a moment. Basically, he was up a lot more in October. First question I would ask you, are these numbers good? Now, if somebody asked me that, I don't really know the answer to it because I don't know how you put these numbers up. If you took crazy risk, that's one thing. If you, we basically would need to dig deeper. But assuming that these are from a reasonable risk structured swing trading methodology, I would say these numbers are beyond good. In fact, as I sat down in front of a spreadsheet while we were talking, and this 3.4% monthly continuously compounded ends up real close to 50% a year. 50% account gain a year. Of course, it never really compounds like that, but it's a pretty good measure of just asking yourself reasonably, is this a good number? Objectively, these numbers are great. So something happened in October, and as we dug into the conversation, he told me a few things. He said that he was up almost 10% at one point in October. And he asked some questions, and I asked the questions back to him. What were you doing to generate that? Were you pushing a little bit too hard? Or, and it's not always clear, or did you just experience a perfect alignment of market conditions? Well, it also came out that he was very excited about having his first 5-figure month, and that was a goal. So that probably, what you're seeing here is a lot of subtle influences that play into a trader who's put up a lot of trades and doing a lot of things right. When you're a little uncentered, a little unseated. And yes, we also need to acknowledge that October was a different kind of month. And see, this is another advantage this person has. There have been a lot of people that if you've started trading in the past 5 or 6 years, you've seen one kind of market. And that kind of market does not include what we just saw in October of 2018. However, if you're a new trader, everything's new, and you kind of have two places to be, right? If you are an experienced trader and you've traded through AsianFinancialCrisis.com, the 2008-2009 financial crisis, then you've seen some stuff. Let's say that. Like sometimes I'll jokingly say I've seen everything, which is absolutely not true, but I've seen a lot of different things. The other place that I think is a pretty good place to be is where kind of everything is new. And if your trading resume is if you just start, let's just say if you just started in the last year, you've seen a lot of choppy conditions, you've seen some crazy ups, you've seen some crazy downs, and you have a sample of market action that I think will serve you very well. If, on the other hand, you've been trading 5 or 6 years, you might tend to view the last year as an aberration because there were good chunks, and actually even a good chunk of the past year, where if you just bought the handful of stocks people were talking about, they kind of went straight up and end of story. And if that is your perspective, then we get into a choppier market and it gets a little bit tougher. However, this guy got within striking distance of an arbitrary financial goal. So no doubt he started to push a little bit more to get to that goal. Also, the stress level went up. The stress level, and this is something that I don't think people appreciate fully, the stress level went up for 2 reasons. The stress level went up, one, what we're just talking about. Actually, it went up for several reasons. So one is he sees that goal just in sight. And this is a very competitive individual. So, he's driving and pushing and he's going to get there. He's going to, whatever it takes to get there. So there's that. There's the second piece that no matter how much we try to insulate ourselves, you still hear the news. You hear that people are stressed out and freaking out and talking about the end of the financial world and on and on and on. So there's a good deal of stress in the system. But the third thing, and this is the piece that I don't think people appreciate, success can really be challenging. Because if you go, as this individual has, from a program of paper trading to trading very small, to then trading with meaningful amounts of money, and then you have success, the meaningful amounts of money, the open P&L you're carrying on your book is much larger than anything you've experienced at any point in your trading career. And the losses, when they happen, are bigger than anything that's happened to you in your trading career. I can remember many, many, many times as I increased my size and had relatively normal losses, there were points where I realized that I just basically wiped out a good chunk of all the money I ever made trading. And you can't really think like that because that's, really, I remember one time doing the math and saying, oh, wow, I just lost all the money I made the first 5 years of my trading career. That's good, right? It's kind of this idea of your biggest loss, hopefully, always being ahead of you because you're always going to be growing. Your account size is always going to be growing. Maybe you'll settle in. There are plenty of people that say, I want to trade $1 million account, and that's where they stay and that's where they live. But while you're developing, these are the types of curveballs, the market, and just this difficult task of learning to trade. All of this stuff comes at us, and it's hard to see with clarity. So let's think about these numbers again. August, you're up 1.5% at the end of the month. September, you're up 4% at the end of the month. October, you're up 10% at one point, and you close the month out with a positive 3.4%. And I said to him, let me guess, you feel like a complete and utter failure. This is one of the worst feelings in your life, right? You just booked 3.4%. And he laughed. He said, yes, and he didn't ask how I knew, because I've been there too, I know. And then when you objectively point out what 3.4% compounds to over the course of a year, you begin to see it a little bit differently. So the problem here is, and I know this has kind of been a rambling, I think there are a lot of lessons here, and rather than me boiling it down to bullet points, I thought this was such an instructive situation that I just want to give it to you, and I want you to deconstruct it. But we're not done, because I'll tell you where we're going next with this. So I was very pleased and he's had a bit of a rough start for November, but it's trivial. It's fine. So the first thing that I wanted to do in any situation like this is stop the bleeding. How do we stop the bleeding? You get smaller, or you get flat and you don't take any new positions. Or if you do take positions, you think very carefully about that decision. We'll talk about that in a moment. So I was very pleased to hear when I said, what do you have on right now? And he said, I'm flat, I have no positions on. Correct. That's the right answer. That's what we're looking for, right? So the first thing you need to do, you're in a bad place psychologically, because in your mind, you just lost 6% and change. You didn't make 3.5% in October. You lost 6%, because I'm horrifically rounding numbers, I realize, whatever. So he is focused completely on the loss. And when you get into this loss mentality, even this loss avoidance mentality, and this was another thing that came out in the conversation. He said to me, I don't want a losing month. And then he said, I don't want a losing or a break-even month. Immediately, I said, tough. It's one thing if you're a very, very active trader. Let's say, because this is one of the arguments, which I think is a little bit flawed, but it's one of the arguments for being a very active trader. If you're the kind of trader that's doing, let's just round it off and say 100 trades a week, well, it's pretty active, right? You can reasonably expect you will very, very rarely have a losing month. If you're a swing trader, trading on a daily time frame, and I like to say, holding trades a few days to a few weeks, you're going to have some losing months. It's fine. It's just the way the math works out. You have a lot of months that kind of net out, and you have some big winning months, and that math works out very well. And hopefully you don't have many big losing months. So, there'll probably be a few lurking there for various reasons. So this really is where I believe we are with the psychological issue here. And that, to me, became the whole point of the coaching session. And those of you who know my work well know that I'm a little suspicious when we focus too quickly on trading psychology. The people who do that, in my experience, are the people who are selling trading psychology solutions. And it's a very murky path, because it's very easy to say you just got to keep working on your psychology, and if it doesn't work, well, that's your fault. You need to do more work. You need to buy more courses and whatever. And I'm being a little bit cynical, but the reason that I'm being cynical is because my belief is, in most cases, psychological problems resolve themselves when we do the right thing in the market. For instance, I talk to a lot of traders who don't have an edge. They whether they're working at prop shops or they're trading at home, swing trading, scalping, anywhere in between, whatever they're trying to do, they don't have an edge, so they're just kind of churning and winning some, losing some, but net, they have no reason to be making trades because they do not have an edge. And this is why I think the trader's journey, the developing trader's journey, really starts with verifying that edge. If you do not have an edge, you should have psychological problems. Something is wrong with you. If you do not have an edge and you're perfectly comfortable executing and bleeding money into the market, you should feel like crap about that. You should say, no way I'm going to do that. So that's really my emphasis away from psychology, is an emphasis toward having an objective edge. Now, I think this guy has an objective edge, and I think that he's proven it to himself multiple times. So how do you know when a problem is psychological versus a problem of not having an edge, or also a possibility is a problem of market conditions? For instance, this is being recorded in October of 2018, and if you are a trader on the daily chart in currencies, so we would say you're a swing trader in currencies, you've had a few months this year where you probably could not have found a losing trade. There were, earlier in 2018, there were several periods where just basically any currency chart we looked at gave us money. And then we've also gone through a corresponding period where it's been a little bit hard to find a losing trade. And recently, we've been in an environment where we'll get lots of triggers and we'll get things that move in the right direction for a few days, and then they reverse, so there's very limited follow-through. Now, that is a problem of, I hesitate to even say it's a problem. To me, it's just part of the great grab bag of the kinds of trades that we experience. In other words, I would say it's probably technically not a problem, but that's a reflection of market conditions. So is this guy's performance a reflection of market conditions, that something is happening in the market, whether it's follow through, whether it's volatility, whether it's correlations tightening? That's one question we have to ask. And the way we ask that is primarily in trade analysis and journaling. Another point that came out of this coaching session, when I mentioned that, he very sheepishly admitted that he'd not been keeping his journal updated. And see, I know personally, one of my tells, one of the ways that I know I am not trading well is if I don't want to do my record keeping. If I just can't bring myself to do it, I really have to force myself to do it. I know those are the times that I need to do it more, and those are the times that I need to think even more seriously about what's going on in my trading. So he does have a little bit of an issue here, that his records for this period are not quite as pristine as we might wish. And that's a lesson to every one of you listening. We talk about journaling, we talk about the importance of journaling, and you hear it so much that if I start talking about it for about another 20 seconds, you're all going to be rolling your eyes. Okay, fine, okay. But let me tell you this. When you need to do it most is when you least want to do it. So when you find yourself really struggling and fighting against the discipline of maintaining the journal, that's when you know you need to do it most. So you go back and we're still kind of swirling around this question of how do we know it's psychology. And to me, it was quite obvious listening to him speak that, and this is where maybe having an outside perspective, whether it's a professional, whether it's a mental health or a finance professional, It could be a friend. It could be a family member who doesn't really know that much about the market. Could be a trading teammate. I think more traders should work in teams. That's something we need to talk a lot more about. You could bounce it off of people in a trading room on a message board. Depending on the board, you're going to get very different quality of discussions. But it was very obvious when I started to hear the focus on the target and then the loss avoidance. I don't want to have a losing or a break-even month. There's some weird quirk of psychology that when we focus on not doing something, when you focus on not hitting the golf ball to that spot, where does the golf ball go? If I'm playing a piano piece and I think, oh, I always fumble this passage, I got to be careful not to make that mistake. It's guaranteed I'm going to make that mistake. And when you start thinking, I don't want to have trading losses, I don't know how it works. I mean, yeah, I guess I do. How it works is like all of these little subtle factors, and it starts to look like magic. This is why people get kind of superstitious about it, because it is remarkable how all of these little things, but what it is, it's a bunch of little nudges. It's a bunch of little things that you're not doing, you're not seeing as well. And we use that word trading edge, and it really is even a strong edge is a thin edge. And if I can take the image to another level of absurdity, maybe, that when we trade, we stay balanced on that edge. And it is precarious. It is even for an experienced trader. You know that all it takes is some upset in your life, something to destabilize you, and all of a sudden, this edge that you've cultivated through decades of your trading career could be in jeopardy. And your trading can go from success to failure very, very quickly. So the answer to this, I believe, is first of all to stop the bleeding, which we've done. I gave him a book to go read. He's going to chill for a few days, and then no big deal. He will start looking for good positions, and we'll put on, when he feels ready, we'll put on positions in a disciplined way and just do the right thing while he monitors his mental state. And, I can remember many, many points in my trading career when I had strings of things that were almost too good to be true. Whether it was long strings of winning days as a day trader, going so many weeks without a losing week, or certain P&L goals. And I never, there were times that I was tempted. If you put yourself in the situation where you come in every day and you have a string of winning days and you're so terrified that you might have a losing day, there's some part of you that just says, let's just do a small, stupid losing trade and go watch Netflix all day and book a losing day. And maybe there's something to that. But the right way to deal with this fear of having the losing trade, losing month, losing whatever, right? It could be a single trade. It could be a bigger set of trades. But whenever you have this fear of loss, the right way to handle that is truly to embrace that loss and to know that it is going to come. You are going to have that losing month. You are going to have those losing trades. And the reason you will have them is because the same process that generates your winners, that will, on balance, generate more winning trades than losing trades, that same process also generates some losers. So I just, like I said, I wanted to give you something a little bit different. That is not a you can probably tell I did not work from an outline. That's sort of stream of consciousness. And I did, tried to protect his identity and the specifics of his situation reasonably well. I did have his permission to share this information with you. But I wanted to present a real trader's real struggle. And it is not wrapped up here in the lesson tied with a bow and here's what you need to do. It is a complex situation, and I also wanted to share a little bit of my thought process about it, and I hope that was interesting and you can extract something from it. We do have a couple more questions here, and these are a little bit more to the point. So Pascal says, just to clear things, this is a question about support and resistance. Just to clear things, I have seen in some places people talk about a resistance or a support because of a pivot point. To me, support and resistance need to have 2 points to even be considered. Is this true? And he says, for example, if you have a 52-week high and the market failed to pass it, would you categorize that as a resistance? So I'm going to tell Pascal something here that he already knows. We don't talk about support and resistance. No, it's not Fight Club. We don't talk about support and resistance. In fact, we're very, very careful, even mentally, to say potential support and resistance. That is the key. If I'm putting examples in a book, I could find lots of beautiful examples of support and resistance. But the reality is when the market is coming up to a level, we don't know if it's going to be support or resistance. And this makes it difficult to test quantitatively. And it makes it a little bit difficult to, some people are very suspicious of support and resistance trading methods because there is an element of subjectivity. And you could not guarantee if maybe a very, very experienced trader, but even then I would admit there's probably some subjectivity that if you give me 100 charts and have me outline key support and resistance and then give me those same charts a month later, I don't know that I'm going to reproduce exactly the same lines. It's going to be very, very similar, but there are probably going to be some that are a little bit different. So there is an element of subjectivity. To his question, so he's asking about a pivot point, and the word pivot means many things to different people, but what this means is a definition that he's taken from my trading course, which is a pivot high is a bar that has a high and has 2 lower highs on either side of it. So it's a bar that sticks out. And he gave the other example of a 52-week high. And I would say yes. Many people think that if you carry this to the extreme, it gets a little bit silly. But the idea is that any place the market has stopped before, the thinking is that it stopped there for a reason. I'll say, yeah, okay, but sometimes that reason is random. That'll make some people very angry. So if that makes you angry, I'll say it a few more times before we're done here, so you can be even angrier, okay? But so the idea the market has stopped there before, and then we will watch with interest. So if you can imagine a market going up and it reaches a point and can't go any higher and comes down. Well, the next time the market gets to that point, no, there have not been 2 tests. There's not been a test of the level, but there is a potential resistance level there because that's where the market stopped before. Now, some people would make the argument, here's where I think it gets a little bit absurd. Every bar's high and low is a point at which the market stopped. So every bar's high and low could be a potential support and resistance point. I suppose conceptually there probably is some truth to that. When I'm reading intraday action around previous highs and lows, whether it's a stock or an index or commodity or a currency. For the currency, it's a little more complicated because we need to think about the different sessions, really, right? Those levels are important. So I suppose there's some truth to that. But of course, if you look at a chart, you'll see plenty of times where the highs and lows of previous bars are run over. But the short answer to this question is You can define it however you want, but for my taste and experience, we do not need multiple tests. A single point, just seeing where a market stopped is enough. Last thought, let me make this more complicated. Do be aware that your charts may be adjusted. If you're looking at futures, then certainly if you're looking back in history, a continuous contract is almost certainly adjusted. You could have unadjusted charts. I look at both when I trade futures, and you may also, depending on your data source, some stock charts are adjusted for dividends, and your charts are certainly on stocks adjusted for splits and reverse splits and some other corporate actions. So just be aware, if you go way back in history, some of those levels did not actually trade, but that's an entirely other subject. I have a bunch of other questions, and I also had the practice and learning technique that I wanted to share with you. But I think this is a good place to stop. We'll do another Q&A here soon, and I will share that idea with you maybe we'll do a whole music podcast. I'm kind of thinking aloud, as you can see. So we'll wrap up here. I'm going to ask you to go check out my website, marketlifetrading.com. There is an extensive free trading course. We also have a number of subscription options if you want to see. You can listen to me. I don't ramble quite this much every day, but you can see my. I'm joking when I say rambling, but you do get my daily analysis of markets. Go through the important things that we're looking at in global markets. A ton of screening tools, various quantitative tools. The best intraday tracking system I've ever seen when I'm away from the screen. I find it completely sufficient to keep me in touch with the markets, and many of my clients also report that it's very useful. So go check that out, marketlifetrading.com. If you have not already seen it, check it out, see what we can do for you. And I will be back with another podcast very soon. Thank you very much.
Well, it's never hard